In this sessions, I will be dealing with the basics of financial accountancy. A brief introduction about me. I am Rajiv Ranjan Jha. I am MCOM and UGC NET qualified. Okay, this presentation of mine will be more useful to the person who are the beginners in accounting and MBA students who aspire to be successful in the field of business as entrepreneurs and managers. So I don't say that my this presentation will be very beneficial for those who are already studied or who have given some of their years to accountancy. They may find this presentation to be a bit dull, but yes, this will be quite useful for those who are just started as in class 11th or maybe in their MBA courses. They have to, because they are from the science background, and they have to learn the basics of financial accountancy. Okay, friends. So without wasting much of your time, we just move ahead. Okay, friends. What is accounting? So accounting, by the definition, it goes as it is the art of recording, classifying, summarizing, and reporting of transaction with the aim of showing the financial health of an entity. So this is the definition part. And you see there are few words which are of importance. So these words are like recording, classifying, summarizing, and reporting. So what we are recording, we are reporting these transactions, day-to-day transactions in which happen in a business in due course, and then we summarize it and we find the health of that entity or the business corporation. So what will be the health of that business corporation? Okay, friends, it will be the ascertaining what amount of profit, because if anybody starts any business, let it be a sole proprietor, a person, individual person, or a partnership firm, or a corporation, however small, however big it may be, but the main aim of this any business entity is to ascertain at the end of a year or at a certain period to know what is their profit, because then only they will know that in which direction they are going, and also the health. So the health is also known by the balance sheet. So many of you will be acquainted with profit and loss statement and the balance sheet. For those who are new to commerce, you don't need to worry on this. We'll subsequently deal these things in very detailed manner. In simple words, it is the language of the business, which has the same meaning for its readers anywhere. Okay, friends. So here I will like to mention you who is regarded as the father of accountancy. Okay, friends. It is the Mr. Luca Pacioli or Luca Paciol. He was an Italian some 400-500 years back. He is regarded as the father of accountancy, and most of the theories or whatever you come across is given by him. And to add up to those friends, that he was actually a mathematician. So accountancy was something very new at that time. So he cannot be a person who has dealt all his life with that. So he propounded the theories which are so important that still now we are all dependent on that. Okay. And as we all know that accountancy has many branches. So one of them is financial accounting, the cost accounting, the management accounting, etc. So what we will here deal is the mostly the financial accounting part, in which actually mostly if you say in a layman's concept, it is that part of the accounting which deals with ascertainment of the profit and the business position through balance sheet. So cost accounting and management accounting are a bit different. Cost accounting, in a nutshell, I will tell you that it has to deal with the cost of production of any object which we are trading in. So the main aim of cost accountancy is to decrease the cost. So if the cost is decreased, you all know that the profit or the profitability for that business unit will increase. And what is management accounting? In a very lucid manner, we want to say that it is the use of financial accounting and cost accounting for the management purpose. So it is for the internal thing. It is not for the external this thing. But financial accounting, as you know, why I am saying it is for external also, because suppose if your profit, who all are interested, even the outsiders, say even government organization, the government organization also needs to know what amount of profit you earned in this particular financial year, so that you can be taxed on that particular amount of profit. But management accountancy, it has to be for the managerial purpose, so that the company improves. And cost is also somewhat like you have to, it is for the internal purpose, but this is for both internal and external. Okay. Now we, as I told you, that we will be dealing in financial accounting in this and the basics of the financial accounting. So what is this? This is the branch, and it is, as I told you, is mainly concerned with the recording of transactions, because profit or anything can be ascertained only when the transactions are recorded in a particular manner, in a scientific manner, in a manner which is understood by everyone and everywhere in the same way. And then what we do, how we go to determine the profit and this business position is by preparing of final accounts. So preparation of, what are those final accounts? Preparation of profit and loss account to know the profit for a period. Generally, it is taken as a financial year. Okay, friends, financial year, it mostly starts with 31st, it starts with 1st of April and ends on 31st of the March. Okay. So in other words, matching of revenue. How will you know the profit of an organization? Yes, friends, you will come to know the profit of that organization by matching the revenue or the income of that organization with the expenses incurred for that period. Then if we match both these things, so we come to know the profit for that organization. Okay. And then what is, as we have coming across this term very frequently, so just as this is preparation of balance sheet, which is actually a snapshot of business health. It is summary of assets, liabilities, and capital. Okay, friends. Now you see there are few words which I have deliberately marked as red. What are those? First is here revenue and income, then the expenses. Then in balance sheet, I have marked the three words in red. First is assets, then the second word is liabilities, and the capital. So why I have marked this thing in red is because in this presentation, we will limit ourselves to these 5 words which we have marked. Okay, so we'll be dealing with assets, liabilities, capital, or in other words, it is known as the owner's equity, and revenue or income or expenses and expenses. So friends, these are the 5 words, or these are the mostly those 5 accounts on which the financial accountancy is totally based. If you understand these 5 words, if you don't have to remember these words, or you don't have to remember the definition part, if you are able to understand this conceptually, so I believe that 70 to 80% of your task is achieved, and rest for 20-30% only you have to be dependent for learning the other concepts. But this entirely comprises of your financial accountancy in nutshell. Now, you see in some of these I have written something in brackets. Okay. So friends, what are those in brackets? I will not start with the first. I will tell you the reason later on. I will start with the second. Liabilities. It is, brackets is source of funds. Capital and owner's equity. It is again the source of funds. So these are the two source of funds. Okay. Now you just close your eyes, friends, and imagine that you are going to start a business from, say, next month. Okay, friends. So what comes to your mind? Yes, the first thing which comes to your mind is, do I have any capital, or how much amount I need to start a business? So that now for starting any business or most of the business, you need a capital, or you need an owner's equity. And suppose your business is, for starting the business, you need 1 lakh rupees. You are only having 20,000 at present. So how will you start your business? Yes, you will have to incur some of the liabilities, which is again the source of funds. So the source of fund can be a bank, a financial institution, or a individual also. He may give you some, say, so you take some 20,000 from an individual. So now you have 20,000 your own, 20,000 from other person we have taken, who is a liability to that organization or your business. And Then you go, now you have 40 for the net rest 60,000. That is 1 lakh was your business need. Starting the business, you needed 1 lakh. But now you have your own 20 plus liability is taken from others 20. So for 60,000, you go to a bank or the financial institution. They will give you 60,000. Now you have the adequate capital to start your business, which requires actually 1 lakh. Okay. So this part is clear that first you need a source of funds. So after that, you will apply those funds. So this application part is the assets. Okay. And then your aim will be to generate this revenue or income. So, but can you generate it without incurring any expenses? No. So here, in order to get this aim satisfied, every business has to incur an expenses. So now you know how these terms are related. Yes. Okay. So starting of the business, you require this to maybe not liabilities. Maybe you have sufficient fund yourselves. So you will, at that time, there will be zero liability, but mostly it doesn't happen in a practical world. You really depend on other sources than your own individual sources. Then you apply those funds to bring some assets. We'll deal in detail in all these five accounts, five type of accounts. We'll deal in details, don't worry. But just in a snapshot picture, I'm telling you all this. So with the aim to generate revenue or income, you will apply these funds to create an asset and you will generate revenue and income. And in that process, you will have to income expenses. So now we come to the detailed explanation of each and every term. Okay, friends, as I told you, assets. Can we think of any business without it? Okay, you don't have any idea about it. Don't worry, I will just show you a photo, then you will come to know. See, what is this? This is a building. What is this? This is plant and machinery. This is trucks for the earth movers, or and this is what you call furnitures. This is for your logistics, and this is your computer and office peripherals. This laptop, computers, calculators. So can you think of any business without having any of these? Or maybe it will have all of these, some of these, and at least few of this will be surely there when you think of any business. Because at least if you start a small coaching center also, you will need to have a premises where you can teach your students. If you are interested in having a production of some item for resale, for selling and getting a profit out of it, you surely require a plant and machinery. And if you are into this office sort of thing, maybe you are into consultancy or something, so you will require furniture, at least furniture, then this laptop, computers. So whatever business we start, we require to apply some funds. See, this is, as we told you, that application of funds is the assets. So we need to apply those funds to at least start our business for purchasing of this type of thing. Okay. Now we come to the definition part. So assets are the valuable resources that are owned by a firm. Here few words will be very important. It has to be owned by a firm, and it is a valuable resources. It is, as we are discussing continuously, it is the application of the funds. They represent probable future economic benefits and arise as the result of past transaction or events. Okay. So for getting to be termed as asset for an business, so what it has to have, it surely have to have a economic benefit in future. Okay. So benefit in future means not a single financial year. It needs to have a benefit, economic benefit for an organization, say plant and machinery. At least you will use that plant and machinery for say 5 years, 10 years, 5 financial years, 10 financial years. So you will need to, you will get the economic benefits for more than a financial year. Okay, so these are the economic benefits. And it happens due to the past transaction, because past transaction means you as a owner got some amount of money as a capital, so which was done in past, and with that capital you purchased an asset, say plant and machinery. So this happens with that past transaction. Okay, now we come to the example parts. So a simple example, cash. Yes, every business have sustainability of a business depend on this liquid asset. Okay, so don't confuse with if I am using any term before an asset, liquid asset as I told. So if for liquidity purpose you need cash or the bank balance, your money should be in the bank. Then as I told, you may not require this asset or may not require in all the business, but this is land and building. Most of the business organization require it. And similarly machinery and etc. Okay, so this picture is very clearly it is saying what is the asset. So assets are something which an organization, if it suppose, if now you start from the reverse side of the business, so it is from the fag end of the business. Now you started a business, it run for 20 years, and after 20 years the business is going for a winding up. So before start teaching you business, I am going to teach you about the winding up part. Okay, friends. So when you are going to wind up your business, all your assets, whatever assets you have, it can surely be converted to cash. Actually, why you will convert those assets to cash? To meet your requirements. See, now in before starting accountancy, you friends all you have to have one assumption very clear. This is an accounting assumption which is assumed actually, and it the whole accountancy is based on that assumption. So what is that assumption? Business entity concept, or it is a concept, so in which it is told very clearly that business is different from its business owners. So what happens when you are preparing now accounts and subsequently the profit and loss, then the balance sheet, so everything has to be done by thinking this concept in your head, by keeping this concept in your head, that business is different. Because see, if business is not different with the owners, then what happens? Suppose the fund which you are as a owner you are putting into the business, so that fund business is having it's on his head as a what you call liability to the owner, or it is to the owner which has to be paid on winding up. So at that time, how you can pay meet this owner's liability, or the outsider people, or the bank which I told you that it has given you fund in the beginning. So you can meet all those liability only by selling off these assets. So assets are something which can be converted to cash, and cash is also a asset because as I told that cash is already converted. So it is an very important asset for an organization. Now, some examples. Are they assets or not? Sunlight. Yes, it can be an asset because see, it has got a economic value. It will be health benefit in terms of health benefit and all, but it cannot be termed as a asset for a particular organization till the time the that business is owning that asset. So I cannot claim that I have the ownership of on sunlight. Any business cannot claim till that person business is involved in solar power generation. So till that time it cannot claim on sunlight. But if suppose it is a solar power generation unit, so surely it can claim the power generated through sun rays with that solar power plant will be an asset for that business. But as of now, if you have no claim on that asset, so it cannot be termed as a asset for you. You have to have a claim and it will have a economic benefits for you in future. So these two things, economic benefits in future and ownership, these two things are required to be termed as a asset. Now furniture, surely if you have, it is an asset for you. It can be converted to cash. Cash already illustrated in detail. Bank balance, oh yes, it is an asset. So these three are assets. This may be or may not be an asset. Okay, now we have already discussed the application of the fund, that was in the asset part. Now we've come to the sources of fund. And what was those sources? The sources were assets and assets was the application. Then sources were liabilities and the owner's equity or the capital. So owner's equity and the capital is this. Owner's equity represents the owner's residual interest in the assets of the business. Yes, this is the definition. I will deal it. First, I will deal it in simple words. In simple words, for the time being, it is the amount invested by the owner in the business. Okay, so this is what owner's equity or the capital is termed as. So, as we said, owner's equity represent the owner's residual interest in the asset of the business. Will so what will increase the owner's equity and what will decrease the owner's equity? Residual interest. Residual means what is left. So something will surely increase the owner's claim or the owner's equity or the capital invested, and something will decrease it. So any ideas, friends? Okay, so one thing is that if I started business with 20,000 as we have discussed earlier, and then after say 2 3 years again I have some money and I feel like if I invest it in my business again, the business will grow further. So now I invest say again 20,000. So now my residual interest becomes in the business. My residual interest will be this owner's equity or the residual interest in the assets of the business will become 20 plus 20, 40,000. It will not remain at 20,000. So recapitalization, yes, the word is recapitalization will increase the owner's equity. And at the same time, suppose what is the aim of the business? Yes, the aim of the business is to earn profit. So who the profit will be given to or whom the business will owe that profit to? Yes, friends, it will be the business will have the responsibility to give that profit to the owner of that firm. So that profit will increase the owner's equity. So now what will decrease the owner's equity? Any ideas now, friends? Because increase part we have dealt with. So decrease part will surely come to your mind. Yes, drawings. Actually, drawings or withdrawals is nothing but if the owner, suppose he invested 20,000 in the start of the business. So after 3 4 years, he wants to take some amount for his own consumption. So for his own use. So what he will take? He will draw or withdraw some amount as which is termed as drawings from that business. Say he withdraws 5,000. So now his residual interest will be only up to 20 minus 5. 15,000. It won't be 20,000 again. And yes, as profit will increase the owner's equity, so the losses will decrease it. Now, as we discussed, friends, we want to start a business with which requires 1 lakh, but we are having only 20,000. So we want to arrange funds. So whom you will go? Yes, you may go to your friends, family, relatives. So these type of people will be actually liability. They will not be directly the owner of the business, but they will like to invest in your business so that they get some amount as what you call interest. So, but the ownership will be still with you, but this person will invest in your business, say 20,000 for some amount of interest. So this person will be termed as the liability. Okay. Now, but the liability or the so suppose it was not your friend or your family gave you further 20,000, but that was not sufficient to meet that 1 lakh requirement. So as we discussed earlier, we go to the financial institution. So now the financial institution gives you the residual amount required, that is 60,000. So now you have the adequate fund. So but what happens? This amount 20,000 invested by your family or friends in your business or 60,000 invested by this bank in your business, you will have to repay them. Yes, repay part. Now with any liability, you now incur a what you call obligation. So this word obligation is very important when we are reading liabilities. So obligation comes when the moment we incur a liability, or in other words, we are required to pay, or your business is required to pay that amount to the bank or to the financial institution or to that individual from whom we have taken money, and also it's some part as interest. So liability, now the definition part. Liabilities are the present obligations of the firm. They are probable future economic sacrifice. Future economic sacrifice. How will you meet your liability? Yes, you will have to sacrifice with some of your assets, maybe your cash, or maybe you will have to sell off something. But generally, it is done through cash and the bank balance. Generally, the business will not like to sell off their assets to meet their liability. So, whatever the cash generation generated through profits and all, so you will have to sacrifice them, your economic benefits or the assets, which and then to meet the liabilities. They are probable future sacrifice of economic benefits which arise as a result of past transaction. Past you have incurred that liability. In future you will have to invest your, or you will have to sacrifice some of your economic benefit to meet this liability. In simple words, the amount that a firm owes to the outsider. Who are called as outsider? Outsider are those persons who are anybody who are invested money in your business besides the owner of that business. See this, friends, actually if this is the business, so this is a burden on that business to pay this amount in future, maybe after say 3 financial year, 4 financial year. So this is termed as a burden and shown as the burden to the business. Okay, but without this burden, without incurring this burden, you cannot start also your business, because you need a amount, sources of fund. So what will be the sources of fund? As we discussed, your fund, capital, and the outsiders fund. Now we come to the, as I told you all friends, that the person who is regarded as the father of accountancy is Mr. Luca Paciol. He was a mathematician. So we all know that we, as a mathematics students up to class 10, 12th, or maybe later also. So maths is something to do more with equations. And in equations, the left hand side of the equation should be equal to the right hand side of the equation, or in simple words, LHS should be equal to RHS. Whole of our early part of our students life goes in balancing this equation, LHS equal to RHS. So this accountancy, as it was invented by a mathematician, it, yes friends, it has also to have an equation. So what is this equation? Final accountancy is based upon the accounting equation. So this is the accounting equation. Assets is equal to liability plus owner's equity. How it is? So because as I discussed with you all, that assets is the application of the funds, and which should be equal to the sources of funds, because you as a owner invested some amount with liability from the banks, outsiders we discussed. Again, these two are the sources of that funds. And you, why? Because you did for some applications. You purchase land, building, machineries. With those, these are what? Application. So application of the funds should be equal. And I tell you friends, if you understand this equation properly, conceptually, then you don't have to remember anything in accountancy. You only have to always keep in mind that this equation has to be in balanced state. This is mathematical equation which must be balanced as discussed. Say if the total assets are rupees 300 and liabilities are 200. So you can very easily, as a math student, you can deduct 300 minus 200. So the owner must have invested, or the owner's equity will be rupees 100 in that business. Owner has invested only rupees 100. So very simple words we are dealing it. Now we have the sources of the funds, that is the liabilities and the capital, and we have application of the funds. Does that amounts to your business? No. Your business will only be dependent on revenue generation. And as I told you friends, that revenue generation will be done through incurring some expenses. Okay. Now revenue or the income generation. Fees earned from providing services. Now we are dealing with the definition of revenue. So fees earned from providing services if you are into consultancy, and the amounts of merchandise sold if you are selling something under the accrual basis. See, there is some word accrual basis. We will, don't worry, you will not understand. If you are not understanding it, you are understanding it better. But if you are not understanding it, we will deal it with at length. No problem. So under the accrual basis, actually the accounting is based on accrual basis. And revenues are recorded at the time of delivering the services or the merchandise, even if cash is not received at the time of. Actually, this is the definition of accrual basis. Whole accountancy or the whole this financial accounting part is based on the accrual basis. It means that the revenues, suppose I am in a consultancy business, okay, and if I have given you some consultancy, legal consultancy, say, and you have taken my legal consultancy, you have not paid me for that lawyer charges. But the moment I have delivered you that the legal advice, I can show in my books of account, or my business managers, my accountant can show it as the revenue has been generated. Okay, because you now the for you who has taken my this thing, what legal expertise, I am a liability to you till the time you are paying me that amount, because you have taken my legal advice. Now this is, and you are for me, you are, as a, I am the legal expert, so for me you are my revenue, or the amount you owned by you is the revenue for me. Okay, so examples of revenue accounts include sales. Sales will be in this merchandise thing. Service, consultancy thing. Say service revenues. Fees earned, suppose you are doing any, say, coaching, so you will do it for a fee. Interest revenue, suppose you have invested somewhere, so that will be interest revenue. Interest income, same with the bit differences. Revenue will be considered when service are performed. We have just discussed, because the accountancy is dependent, or it is based on accrual basis. It is not the cash basis. What is the other basis will be cash basis. The moment I receive my cash from you, then only I can show it as my income. But friends, accountancy is not based on accrual, on cash basis. It is based on accrual basis. Yes. So in this picture, I wanted to show you, this is the main aim for any business. So what is this aim? To generate more and more and revenue years and years after. Okay. So again, the definition, it is the increase in the economic benefits. See, why, what we are trying to do in this sessions, that we are defining all those terms in terms of economic benefits. So it is the increase in the economic benefits during the accounting period in the form of inflows. Inflows. What are outflows? Yes, the expenses part are the outflows, but inflows is the revenue part. This will mostly happen when we render the service or from the investment. How it will happen? The revenue generation in a business, it will happen from by when we render the service, or maybe the goods, or from the investment part. Now we come to the expenses. So what was revenue? Revenue was inflows. Now we are going to deal the outflows. So outflows is nothing but the expenses. And for revenue generation, you need to be incurring this. Otherwise, you cannot have a business. So what are these simple examples? You see rent due, then advertisement, then your office person's salary, or the wages. Actually, salary or wages are two terms which are very similar, but if it is say factory, then we use the term wages, and if it is for a office, we use the term salary. Then you need to have office supplies, say ink, pen, pencil, stationery, everything. So these are all the simple pictorial depiction of expenses. Now we come to the expenses definition. It is the as we told that we will deal everything in economic benefits. So it is the decrease. What was the increase? Increase, yes, increase was the revenue. So this is the decrease in the economic benefits during the accounting period in the form of outflows. That was inflows, this is outflows. So the matching of expenses against the income for that same financial year. I have not written this, but you need to understand that I cannot match the income of, say, 2019 against 2020 expenses. It has to be the same income of that particular financial year that can be matched against the income, will give us the profit for that accounting period. Now I told you, friends, that there are two bases of account can be in accounting basis. So one can be the cash basis, one can be the accrual basis. But friends, we don't follow cash basis in accounting, we follow the accrual basis in accounting. As I told that accounting is the language of the business. So this language, this accrual basis language is used everywhere. So what happens? Cash basis of accounting, we write the revenue at the same time when we receive the cash. In accrual basis, we don't write the revenue at the same time. There can be a delay, because the moment I deliver you the services, or I give you the goods, I can show it as my income, but the cash may be later on received. Okay, so this is nothing much. In accrual basis, there may be a difference in time. In cash basis, there will be no differences in time. Now, in this presentation or this first session of mine, what all we have read? We have read the definition of the accounting, recording, classifying, summarizing of the financial transaction. In simple words, it is the language of the business, so that it conveys the same meaning to the person who are living in India or maybe in USA. It will depict the same meaning. And then we read in details about the assets, liability, capital, expenses, and revenue. These are the five broad heads of accounts, or all the accounts can be either it will be asset or the liability or the capital or expenses or revenue. Broadly five, nothing more than that. So friends, thanks for listening. And if you have liked my video and if you want to encourage me, please subscribe to my channel so that I get the encouragement to give to come up with new videos. Thank you friends. Thanks a lot.